Today we're going to talk about the 10 best swing trading strategies that I have learned in my 14 years of being a trader. I've included a lot of charts. We're going to take a look at multi-time frame strategies. I will show you exactly how to go top down to find the best trades with entries, a lot of practical chart examples. And in part 2 of this video, we're going to talk about what is the best strategy in general, how do you have a higher win rate, and also I've included a lot of tips for new traders or struggling traders. So let's get into today's video. So let's get started with one of my favorite strategies. It's a multi-time frame approach, and the only thing that we are needing here is the 50 period SMA. The 50 period moving average is one of the most important moving averages. You will see that this moving average is being respected on all the charts, on all the time frames, whether you look at Forex, stocks, even cryptos or commodities. The 50 period moving average, in my experience, is one of the most important. And what we are looking for at the higher time frame, we are starting here at a daily time frame where we start our analysis. We want to look for a market where you have a break and the first retest of the higher time frame moving average. So here the market has been trading below the 50 period for a long time. Here was the first time in months that the market broke above the moving average. Now the moving average is being retested, and it's important that we look for the first retest. So the first time the price action is back at the moving average after the break. And then we go to a lower time frame, and on the lower time frame the idea is that there we want to time our trades with the trend. So we determine that on the higher time frame we want to look for buying opportunities, and then we go to the lower time frame and look for information and patterns and just general scenarios that we then can use for our trade timing. So here we are on the 2-hour time frame. You could go to the 4-hour, you could go to the 1 hour, even lower. And what we want to do here is we are looking for patterns. Those can be trendline patterns, it can be horizontal patterns, as we will see later. And here we have a very nice trend line when we connect the swing highs. And the idea is that just because the price is at the daily 50, it doesn't automatically mean that we're gonna buy. We still need to wait for confirmation on the lower time frames. And the idea is that we want to buy when the market is breaking the trend line here. It's also the break of the last swing high. So when the market breaks this area, the price is making higher highs on the lower time frame, which is a very, very important signal. And this is what happened afterwards. You can see the market broke the trend line, broke the moving average, broke the last swing high, and then it traded higher for quite a long time, very extensively, and you could have potentially realized a big winning trade in a short amount of time. So it's in line with the higher time frame. Another example, the market was trading above the moving average here for a long time, traded below it, and then here is the first retest. By the way, the market also did that on the other side. It broke above it. Here was the first retest and a big move up. Now a break below it, first retest. So we go to the lower time frame. This is the daily. And then we want to look for short opportunities. This is what it looks on the lower time frame. Here we are on the 1 hour. Again, we have a very, very nice pattern, a trend line. We also have some type of head and shoulders here, left shoulder, the head, the right shoulder, 2 lower lows already. And the idea is we want to trade a breakout out of the trend line, out of the last low. And this is what then happens afterwards. You can see the market broke out, and this is where you have a new trend starting. And this is very important. On the higher time frame, your idea is that you want to trade a new trend to the downside. So your idea is that after the retest, the market will start a downtrend. And on the lower time frame, we are timing our trades with the higher time frame trend, but because we are getting in on the lower time frames, we often have a much favorable entry because we can really pinpoint our entries. So we can get in early. Still, we have a lot of information. We have the higher time frame information, and we have the lower time frame pattern and momentum and breakout information. And then we can go with the trend early with an entry. On the lower time frames, we can then also use very tight stop loss orders to really optimize and maximize the reward to risk ratio. And if you want to learn more about price action and a multi-time frame trading strategy, then I have prepared a very big special. So I've put together my trading strategies that I trade every single day that I've developed over 14 years of being a trader. I've included all of my rules for entries, how do you find the best trades, how to do a multi-time frame analysis, the best signals, how do you place the stop loss in the right way, how do you place your targets, how do you manage your exits. I've included many trade studies, hundreds of charts, and 4 trading courses for the price of 1. And everything is included in this bundle, where the link is in the video description or also in the comments below. So you get 3 bonus courses on top of my actual trading strategy, and you can download that. It's way more comprehensive and in detail, in depth than all of my YouTube videos. So if you want to learn more, check the links under the video. Or if you want to take this to a completely new level, then we also have a Forex mentoring group. So you get all access to my courses, but you also get access to our live chat room. We hold 5 to 6 live video webinars every single week, and we talk about the current charts. We show what we want to trade, how we want to trade it. We review the trades from our traders. We provide feedback, personalized feedback, and help you get better over time. We hold a lot of special webinars, mindset, psychology, routines, all of the good stuff is also there. So make sure to check the links in the video description if you really want to take your trading to the next level. And now let's get back to the strategies. Another great swing trading strategy is a so-called trend exhaustion. And here the context, well, as always, is key. And what you want to look for is you want to look for a mature trend, so a trend that on the left side has been going on for quite a while. And then we want to look for signs that the trend is losing strength. Because when a mature trend is losing strength, a lot of people who were short here on the left-hand side are probably taking profits. They're exiting their trades because they have already made enough money. And for those people who want to buy, the price is finally low enough that it makes sense. So very often those exhaustion phases will help you find new trends and the beginning of new trends early on. And this is exactly where you want to get in. You want to get into a new trend as early as possible, because there the profit potential is at the highest. So here what we see is, we see that the market has made a double bottom. We also have here a pin bar rejection pattern, something that I've talked about in my price action videos here on YouTube as well. And here you can then see after the breakout, the market is retesting it. So when you see such a exhaustion pattern, you usually have 2 options. First is you could trade it as a general breakout. So as soon as the market breaks out of the pattern and makes a new higher high, at this point, the breakout is signaling that, okay, now we are making a higher high while the market was not able to make lower lows here. This is a very important signal. Or if you are not comfortable trading breakouts, or maybe you missed the first breakout, you could also choose a retest approach or a pullback. And this is how it looks afterwards. So the market broke out, made a move, came back to retest the previous highs, now as resistance. And if you are a retest trader, this is where you then could potentially enter the trade. So you have a few options on how do you find trades. You could also use this information to build a position. So you could take your first entry on the breakout and then add to your position on the retest. This is also a very important piece of information for stop loss placement, because obviously if you know that retests are very common, you will manage your stop loss differently. So you will not move your stop loss too fast, because if you move your stop loss to break even, this is almost always where you see the actual retests. So keep that in mind as well. And then how do you find your target? And one of the tools that you could use are Fibonacci extensions. And I will talk about Fibonacci extensions later in more detail. But what you want to look for is basically the first Fibonacci sequence into the trend. So we draw our Fibonacci from here, the origin of the trend, to the first end of the swing point. So we have our A, B pattern, then you can see we have a nice retracement here. And the idea from our Fibonacci extensions is that usually you will choose your target with the 138 or with the 161.8 Fibonacci extension. So generally what some traders do is that they take the first exit on the 138 and then on the 161, the second one. Some traders, if you really want to bet on having or finding a huge trend, you could even think about a 200 Fibonacci extension, but that's not as common. And if you do that, you will see that a lot of trades will turn before that. So it's always a good idea to scale out before that. And this is how it looked afterwards. You can see the market made a move into 161.8, and then the market for a long time died down. Keep in mind, this is the higher time frame. We are on the daily chart because we are looking for swing trades. And the market pretty much for maybe almost 1.5 to 2 months didn't do anything. And it's probably very hard on your emotions to hold a trade for that long, especially if you're already in profits and you see that your profits are going up and down on a daily basis. You're probably spending a lot of money on swap as well. So in general, that's why I said 138, 161 targets are maybe a little bit more conservative, but your holding time will also be drastically reduced. So that is what I would recommend to new traders. Let's look at a second example. And again, the market is coming from an uptrend. And if you have missed the uptrend and you want to look for a new opportunity, I don't recommend to chase an existing trend. So if you see that the market has already made quite a big move here upside to the upside, I would recommend to just wait, sit patiently on your hands. I know it's hard, but you have to do it. Chasing a market will never work. And I would just wait for signs that a trend is exhausting. So the market made a big move here, and then here at the top, you can see that the momentum kind of died down. It really dried up. You can see the market made a double top here, a little bit of a fake out trap pattern. So the market briefly poked above the previous high, but immediately pulled back. Then you have a huge bearish candle. And this is then the signal that you could use on the lower time frames, for example, to go to a lower time frame and look for a trading opportunity into a new potential bearish direction. So now we are on the daily time frame. This could be our higher time frame. And then we go to a lower time frame and see what we have here. So this is how it looks exactly on the lower time frame. We see here our trap, fake out, spring, whatever you want to call it. Clearly a lot of exhaustion after the strong trending market here on the left. The market really died down. We have a good trend line that we can draw, and it's always nice to have a trend line or a horizontal pattern because we can then use this information to time our trades with a breakout or a retest. And you can see the market already broke out here as the big bearish candle on the daily time frame closed. You see that the market already made the breakout on the lower time frame, and this is where potentially you could get into your short position. And then this is how it looked afterwards. You can see after the breakout, the market really took off. You could again use a Fibonacci, for example, to find your target. You could also just go for a fixed 2-to-1 reward to risk ratio. There are a few options on how you could go about this. Another great concept for swing traders or traders who would like to find good trend following trades are channels. If you can identify a channel on a market, on a time frame, especially on a higher time frame, those can be great training opportunities. And on a channel, the basic idea is that you want to trade with the trend, obviously. So if you have a market that is making lower highs like here, and you can find a channel that is going down, you want to wait for the market to hit the upper area of the channel and then trade into the direction back into the channel. You don't want to trade if you have, for example, a market that is going down here and you have a nice channel. You don't want to trade here up from the lower end of the channel. You only want to trade into the direction of the trend at the extremes of the channel. And this is one of the most important concepts and big mistakes that many traders make when channel trading is that they trade the wrong direction, or very often they trade inside of the channel. You only want to trade at the outer edges of the channel. And again, you could use, for example, a Fibonacci for targets. So if the trend rolls over, you draw your Fibonacci from point A to point B, you have a perfect 50% Fibonacci retracement. It's also here at the highs. And then the idea is that on the breakout below the lows, or maybe even already here, if you have a great situation, you would then time your exit on the 161. So maybe you find some trend following trades along the way with the channel. The idea is that you really want to consider being out of the market latest at the 161.8, because you can see after the market hit 161.8, the trend here to the downside was really over, and the market broke out of the channel and then turned the direction. So it's very important that you know how much you can expect from a trend, and then you are not surprised, you're not chasing it. It's always more recommended to be in a trend early on and not have trend following trades when a channel has been going on for a long time. Another great way to use a channel, which I really like to do, is look for broken channels, because you can see the market was in a great channel here, offered a lot of trading opportunities with the trend, and then when the market is breaking out of the channel, very often you will be able to find reversal trades. So the uptrend was over and now it's time to look for downtrending trades. So you could wait, for example, for a retest of the channel. This is something that is very common in Forex as well. So you have your channel, it is broken here, the market is coming back to retest it, and then you have great opportunities, just like what I've shown you in the beginning with the moving average retest. We could also use that with a channel retest, and I've prepared a lot of great trading strategies later in just a moment when we talk about trendline swing trading. This is going to be really fascinating. So another option, as I said, just wait for the channel to break and then look for a retest, or you can see after the channel was broken, the market even broke the moving average here. And then this is how we come back to the 50 period retest. This is the daily time frame. So you really want to look for the first retest of the daily time frame to find good swing trading opportunities. Patterns are always good. Whenever I see a pattern on a market, I get very interested in a market. However, the context is always key. Just because you see a pattern, it doesn't mean that you should automatically be trading this, obviously. You want to look for a pattern where it actually makes sense in the markets. So here we can see the market was in a strong uptrend here on the left, and then we have a pattern. Now the pattern makes a lot of more sense in the whole context, because the pattern shows us that there was a lot of exhaustion. The market made lower highs. The market wasn't able to break higher. Here was a long consolidation. During the uptrend, the market never really consolidated for that long. So this is already a very big piece of information that we have here. Usually you would like to see a continuation happen quite quickly. And if it doesn't happen, it means that there are probably not a lot of buyers anymore in the market. And then you look for breakouts, you look for retests, and this is how you can trade it. I always get asked when I do the videos, is it better to make or become a breakout trader or a retest pullback trader? And there's not really a clear answer. I have mentored hundreds and hundreds of traders, and what I have seen is that some traders prefer to trade breakouts and are very uncomfortable with retests. And there are other traders who just don't like breakouts. They feel that they don't have enough information. They feel a little bit insecure about breakouts, and they love trading pullbacks. So I really cannot say that there's one strategy is better than the other. It really comes down to how do you feel as a trader. So what do you think? Do you see yourself as a breakout trader or as a pullback trader? Let me know in the video comments below. I would really like to see the majority of our traders, where do they fit into breakout or pullback. So really let me know in the comments below so that I can make maybe the next video about a specific approach where I see the most answers. And then here you can see what happens afterwards, the breakout, the retest with a nice pin bar, and then off we go. So breakouts, patterns are great, and the context is really important. Here we have, I called it the momentum death. So pretty dramatic, but I think it fits here the criteria. So on the left-hand side, you can see the market was in a strong downtrend. In a short period of time, the market moved lower quite a bit. And whenever you see that a market is changing its structure, this is where, as a trader, you should get very, very observant. You should start following the market, because when a market undergoes a change, then there are often great trading opportunities. So when the market goes from downtrend, very strong downtrend, to a market where on a long period there was no momentum, there was no continuation here of the downtrend, this is where you should really get interested in. Even more so when you see something like this here, where the market is already making higher lows. The market is suddenly really interested in trading here into the highs, whereas previously the market was more trading into the lows, which shows more selling interest. Now the market is trading into the highs, so that's a very, very big heads up here that you should have. And especially then when you have such a strong breakout signal. When you have a breakout with a very strong candle, that is really where you should pay attention. And then here you have even a retest. And that is why I said in the beginning that retests are a very common feature in today's markets, and that you need to take this into consideration when you place your stop loss. So many traders place their stop loss always too close. They really suffocate their trades, and they often miss out. So they get into a trade, they see the market is moving a little bit in their favor, and as soon as that happens, they pull their stop loss to break even, and then the retest comes, they're taking out, and the price goes to their target, but without them, because they have suffocated their trades. And you need to plan for retests, because retests are very, very common. So I would really recommend that you start paying attention to retests and see that they are quite common, and then you can implement that in your trading plan. And you can see after the retest, this is what happens. The market started a huge uptrend, and it all started here with this transition. So when a market goes from one trending phase into a transition where the trend is not continued, you shouldn't automatically just go long because the market is going sideways, but this should be your first really big heads up. And then you start to try to create trading plans that could help you find a new trend. I really love trend lines. I've been trading trend lines for probably around 10 years. And trend lines can be really great tools for swing traders. And whenever I see a great trend line, this is where I get very excited. It doesn't mean that I automatically get into a trade, but it is a starting point for my analysis. So here you can see the market giving us this nice downward trend line. We can really nicely describe the trend here. And you can also see that the market pre-breakout is giving us this nice pattern. What is this pattern? You can see when you put an RSI in here, you get a divergence. And then here, when we look here at the right side, here would have been then a head and shoulders, or an inverse head and shoulders. Left shoulder, the head, the right shoulder, and then a strong breakout. So a trendline shift with a lot of context can be a great signal, can be really, really a great tool to get into a trade. And of course, you don't have to trade a breakout. Maybe you just use that as an information, and then you wait for the market to get back here. You wait for the market to come back and retest this area if you want to become a pullback trader. And this is how it looked afterwards. You can see this is where we had the trend line. This is our inverse head and shoulder. This would have been a potential entry on the breakout, but you can see the breakout would have really hit the moving average. And those can be sometimes a little bit trickier to trade. What is often a much better idea is to wait for one more layer of confluence. And we get that confluence here. So what is the market doing now? This is really, really an important piece, because now the market is retesting the previous highs. The previous highs are becoming now support. So resistance is turning into support. And now the market is also rejecting the moving average. And this is so critically important. When you see that the market on the breakout after a really, really important change of market structure is also rejecting the moving average, this is really where new trends often are created. And how do you trade that? Obviously, you have a few options. You could then trade it right at the retest. You could even have traded it on the breakout. And then you could again use Fibonacci extensions for targets. So 161 is usually where trend following traders go for. You could also have obviously an approach where you scale out of your position. So you could have maybe a first target at 161 and then let the rest of the position run to 200, trail your stop loss along the way. And this is how it could or it would have looked afterwards. You could have then chosen to use the 50 period moving average as a way to trail your stop loss. That is how you can very nicely use the stop loss as well. And you can see the market hit 161, hit 200, and then pretty much after that, the trend has died down. So a great way how you can use multiple tools to find a great trading opportunity. We have also continuation patterns. So we don't only have reversal patterns. We don't only have patterns like the momentum death, but we also have continuation patterns. And flags are probably the number one trend continuation pattern there is in the markets. When we talk about classical and conventional patterns, flags are just so powerful. And what we have here is a downtrend. And if you have missed the downtrend, or maybe you're in the downtrend and you want to look for ways how to scale into a position, you could use then a flag. So the market will never move in just one straight line to your target, but there's always this back and forth, and you can use the back and forth to really for your advantage. So you wait for the market to finish a trending phase, then you wait for the market to enter a flag, a consolidation. Here a lot of position building, accumulation, distribution is going on, and we are able to define this pattern here with a trend line. And when the trend line is being broken, this is then often used for position building. So continuation trades are often being taken here, and because flags are used so commonly, that is why often after a breakout, you will see a huge flush of momentum. So on the breakout, you will often see that a trend is really accelerating and making a big move. And then you can see here, the market is entering into a momentum death. Once again, you can see we are moving here lower, resistance, divergence is coming here. We have a higher low, and then on the breakout here, the trend is over. So this is where you then ideally at least want to be out, or at the latest point want to be out when the market is really here breaking out of a structure. So flags are really amazing to trade, and you can also use again a moving average. So this is the 1 hour time frame, but this line, the moving average here, is the moving average from the higher time frame. So we have a little bit of a multi-time frame approach here. And what you want to do is, first of all, you want to trade into the direction of the higher time frame. So if the market is above the moving average, you want to trade long. And you want to trade long at the lowest possible price. And when is the lowest possible price? When the market makes a pullback. So you can see here we have two flags that are coming back into the moving average. Especially here, this is the best scenario. You have a flag that is moving into the moving average. It's retesting it. It's not able to break below the moving average. So this is a great example and a great scenario where the buyers are still in control. The sellers were not able to get the price below the moving average. And then on the breakout out of the flag, that is where you see the very big continuation of the trend. So you can use flags with a higher or multi-time frame approach to trade into the trend. Another great continuation pattern is the triangle. In my personal experience, the triangle comes right after the flag, and triangles have a horizontal level at the top. So a triangle here has a resistance that is for now showing the pause of the ongoing trend. So the market is in an uptrend, then the triangle is being established. At the top of the triangle, we have the resistance level, and the bottom is really here the most important piece to the puzzle, because the bottom shows us that the market is still making higher lows. So there's a lot of pressure building here in the triangle, where the lows are still coming up. So there's a lot of buyers, and every time the market sells off, the buyers are coming in sooner and sooner to drive the price back up. So although the market is defined in the triangle and not making higher highs, it is making higher lows, which is a very important piece. And again, you could choose to trade it with a breakout approach or a pullback approach. Both can work. And this is how it looked afterwards. This was the triangle in the previous uptrend, and on the breakout, this is where the continuation happened. So it's very important, and I've talked about this many times in my past videos, when you see any pattern, whether it's a head and shoulders, a flag, a triangle, the momentum death, whatever it may be, you have to absolutely wait until the market is breaking out of the pattern. Never trade a market inside a pattern. Always wait to get out of it. Inside a pattern, it is very hard to make any money because there's a lot of volatility, there's not a lot of momentum, so the market is fluctuating a lot, but it's not moving a lot. And then it's obviously very hard. Your stops will be easily taken out. It is hard to predict if the market is going up or down. A pattern without a breakout is not strong enough a signal. Anything could happen here basically, but the breakout is really the final piece to the puzzle, and you need to wait out for that. The stochastic cycle trading strategy is also very, very powerful. So what do we have? We are on the 1 hour time frame, but here on the bottom, we have the stochastic from the daily time frame. The period is 1433, so the default stochastic, but it's coming from the higher time frame. And the stochastic is often giving us those nice cycles. And what we want to do is we want to wait for the stochastic to cross into a new direction. Ideally, you would like to see, if you're looking for a cross to the upside, you would like to see it happening very close to the bottom, because it shows then that the market is coming from a nice downtrend. And if the market has been downtrending a lot, then there's a good chance that we're also going to see a nice uptrend. So especially in Forex, which is a mean reverting market, what we can often observe is that after a strong downtrend comes a strong uptrend. And that's very, very helpful for us traders. So here we have a bullish cross. So the idea is that we are then looking for buying opportunities. We don't buy just because there's a bullish cross. A bullish cross on the indicator is not enough. We still need to add our price action analysis from the charts on top of that to really build a more robust trading approach. So what do we have in a price action? We have a trend line. We connect 1, 2, 3 highs, and also we have here a nice pattern. And then what we want to do is we want to trade here a breakout. We want to wait for the market to get above the trend line. And you can see when we look here at the high and low structure, we also have an inverse head and shoulder, left shoulder, head, right shoulder. So we really want to make sure that we get above that. We want to get out of the pattern. Just what I said like 30 seconds ago, we have a pattern, but we need to wait for the pattern to be broken. And then we can go with the momentum. Or we could also wait for a pullback, but we need to get out of the pattern. And this is what happens. The market first breaks the trend line, then also breaks the previous high and retests it. And you can see the stochastic is still giving us the green light, so we are in a bullish scenario. You could also use that to build a position. So you could add, or you could enter your first position on the breakout out of the trend line, and then on the retest above the highs, add to your position, for example. And then we could again use a Fibonacci for trade exit timing. So we draw our Fibonacci from point A here to point B. We have point C at the 50, and then 161 could be our first target here, or even our complete target. And the stochastic from the daily is still giving us the confirmation that we are in a bullish scenario. And then this is what happens afterwards. 161 was hit. The market took a long time to hit 200. So as I said, 200 will sometimes get hit by the market, but very often it takes a lot of time. So usually what I would recommend, especially in the beginning, go for a much more conservative option. Go for a target that is easier hit. You don't have to hold your trades for that long, and that is how you could deal with that. Another example for the stochastic cycle approach, you can see this is the same chart that we have been following on the way up. And here is our first example on the bullish break. We have a nice stochastic from the daily time frame, a very nice cycle. And then here above the 80 level, we are seeing a cross again lower. So now we want to look for a bearish opportunity. And again, we're able to put a price into a pattern. We're able to put a price into a resistance support level. You can see previous resistance is turning into support. We have here lower highs, so we could draw a trend line here at the top as well. So we have kind of a triangle reversal. And what we want to do is we wait for a breakout. And then this is how we could time our trades. You can see this is what happens afterwards. We have a very nice stochastic cycle to the downside, and then here another cycle would have started here at the downside at the bottom. And the stochastic cycle, obviously nothing works 100% of the time, and sometimes those will fail, but it can be a great opportunity and a great strategy to use. Or if you trade any other strategy, you could use the higher time frame stochastic just as another layer of confluence to your trading. So I've talked a lot about Fibonacci's and how do you find Fibonacci's. So a first tip would be to look for a Fibonacci sequence, an ABC, into a new trend. So when the market is going from downtrend here to an uptrend, what I do is I look for the first ABC pattern. And then you draw your Fibonacci tool from point A, the lowest point usually of the previous downtrend, to point B, which is the first swing point on the way up. So you can see the market broke the last swing high here. Then it came to an end and it gave us the retracement. You can see we have A, B, C. We have a perfect 61.8 retracement. The better your retracement, the better the Fibonacci in general is. So you really want to see that the price action is paying attention to the Fibonacci level. Otherwise, it's not super recommended to trade it because the Fibonacci is not very obvious. And the more traders that are able to use a Fibonacci or able to find a Fibonacci, the more powerful generally the signal. So A, B, C, and then how do you trade that? There are a few options. You could, for example, wait for the market to break above point B, above the 100, or some traders, they then look for patterns around the point C. So if you go now to a lower time frame, you're probably able to see here a double top pattern, an exhaustion pattern, and then time your trade here as well already. And you can see this is where we drew the Fibonacci. You can see the market went to 161, went to 200, and then the market died down. So I can't stress this enough. If you want to look for Fibonacci targets, 161 is the one that I would always recommend in the beginning. And if you are a little bit more advanced and you don't have problems with holding times, then you could also choose 200. But generally, most traders start with 161. Another example, in a downtrend, you can see the market was moving higher. Then the trend has turned. The market broke out of the trend line. So when this happens, the market is actively shifting from uptrending market to downtrending market. And at the beginning and at this shift from one trend to another trend, that is where I want to look for a Fibonacci. So I want to see where do we have our first ABC. Our first ABC happens from point A, the highest point of the previous uptrend, to the end of the first swing wave. Then here you can see we have a 50% retracement, and then we could use a 161 as our target. You can see in this case the market really overshot it, but this is very important. This doesn't happen all the time, and very often the market will turn already at 161. But you could again use such a strategy to exit partially 161, scale out 200, scale out 261, and then completely close your position. It's a little bit up to you. Again, I would recommend to just exit the trade fully on the first one and then wait for the next trade. No swing trading video is complete without a moving average crossover system. And here we have one where we use the 10, 20, and 30 period moving average. We can use EMAs, SMAs, doesn't matter, 10, 20, 30. So we have 3 moving averages, which are pretty close by. And the idea of this approach is that we want to wait for the first break and retest through all of the moving averages. So we want to really see that the market is making a move from below above all of the 3 moving averages, and then we are waiting for our first pullback. So you can see this green candle broke all of the moving averages, then the next two retested it, and then this is where we would start looking for buying opportunities into the new uptrend. The market is coming from downtrend, changing the directions. It's very tough to break all of the moving averages after a trending market, and then this is where you want to look for opportunities. You can see this is then where you get into a trade theoretically after the retests have been confirmed and after the market has moved higher. So a big problem and a big mistake that many traders make with retest or pullback trading is that they enter when the market is actually performing the retest, but you really want to make sure that the market is moving away from whatever you are seeing being retested. Even if you're looking for a head and shoulder retest after the breakout, a Fibonacci extension or retracement, you always want to make sure that the market is showing you a reaction away from whatever level you want to see being retested. And this is then where you look for trend following entries. You could also use then another or later pullbacks to add to positions. So here was our first opportunity. The market continued and moved higher. We have our first consolidation back into the moving averages. The market didn't break below the moving averages, which is very important. And then you could draw a triangle here, a trend line, and then wait for continuation patterns. So a few options, what we have already learned, we can now start putting together to form a very, very robust approach. And this is what happens afterwards. You want to make sure that if you are in a trend, you want to make sure that the moving averages are not being crossed to the opposite side. A cross to the opposite side would really signal the end of a trend. So make sure to pay attention to that. One of the most popular moving average crossover systems is the so-called golden cross. And here we use the 50 and the 200 period moving average. So this is how it looks. We have the 50 and the 200, and the horizontal, the vertical lines mark the crosses of the two moving averages. And the idea is that whenever the two moving averages cross, you are looking at a new trending phase. This is ideally used for a multi-time frame swing trading strategy. So here you can see the lower time frame, the lower moving average, the 20, is crossing above it. So at this point, you have the beginning point of an uptrend. So whenever this cross happens from now on, you're only looking for buying opportunities on the lower time frames. And you can see this could have been a quite profitable endeavor. Here you see that the moving averages are crossing into the opposite side. So from this cross onwards, you're only looking for short opportunities to the downside. Here, the next cross. From this moment, you're only looking for buying opportunities into the new trend direction, and so on and so forth. So basically, the daily time frame crossover or golden cross would be your filter. Whenever you see such a cross, this determines the trade direction for the lower time frames. And so you know that when this market has crossed here and the moving average have crossed on a daily, from now on you're only allowed to trade long on the lower time frames. And this could be a great filter for your trading. All right, so now we are arriving in part 2 of this video, and now we're going to talk about a few general questions that I always get about swing trading versus day trading. And the first question is swing trading easier? Is swing trading easier for newer traders? Is there less noise on the higher time frames? But again, I really want to point your attention to our special courses, to our special offers. If you have liked what you have seen in the video so far, I've put together even more in-depth a course. So 4 trading courses for the price of 1. Very limited offer. You will have all my rules, many trade studies with entries, everything that you need to learn for trading a complete trading strategy is included there. So really make sure to check the links in the video below or also in the comments. Or if you don't like to learn on yourself, on your own, we also have a mentoring group where we have a chat room that is open 24/7, and we hold 5-6 live webinars every single week where we talk about trading, the trades that are happening right now. We also review your trades. If you become a member, you can just send us your trades. We're going to review them, provide personalized feedback, and we have a lot of special webinars as well. So is swing trading easier? What do you think? Is swing trading easier? Are the higher time frames easier? Is there less noise? Many traders believe that they need to start on the higher time frames when they start trading. And I have coached and mentored probably around 1,500, close to 2,000 traders over the last 10 years. And I have seen that this is not true. Swing trading is not necessarily easier. It can be easier for some people, but it doesn't have to be that way, because obviously there are lots of challenges when you want to become a swing trader. The biggest challenges of a swing trader are obviously the patience that is required. As a swing trader, when you're on the higher time frame, sometimes you need to wait hours or days, sometimes even weeks for a trade when the time frames are just not aligning. And depending on the market that you're trading, sometimes it can take a long time for the next trading opportunity to come up. And this can be a big challenge, especially for new traders, or especially for traders that are more in a day trading mindset, that really need to have frequent trading opportunities. Otherwise, they will get bored or impatient. So waiting for trading opportunities is obviously a challenge. And then the problems don't stop there. Once you're in the trade as a swing trader, your trades will take sometimes days to evolve. Sometimes the market will spend weeks for your trade to hit the target or the stop loss. So you need to be able to hold onto a winning trade for a long time. And many traders, I've seen it so many times, new traders, when they start out, you don't have the confidence to stay in a trade for a long period of time. And this is crucial as a swing trader. So you cannot really say that swing trading is necessarily easier. There are pros and cons just with everything. There's always a pro, there's always a con. You really have to find out, where do you see yourself as a trader? Do you see yourself as a swing trader? Are you patient? Or do you need the constant action of the lower time frames? Then swing trading is probably not the right fit for you. Is my trading strategy failing? Many traders, they start a strategy and then they have 2 or 3 losing trades, 4 or 5 maybe even. And then they are starting to doubt their trading strategy and they don't know what to do. Should they start a new strategy? But what I have seen very often, and the majority of the cases, this is actually the case, is that the trader is always the weakest link in the trading business. In your trading business, you are the weakest link. I'm sorry to say it, but that's true. And whenever one of our traders is starting to have problems or doubts and maybe hitting a roadblock, I really encourage them to look at their last 10 trades and ask themselves, for each of the last 10 trades, did you follow the rules 100% without exception, and you only executed perfect trades? And then still you had perfect trades and they still lost? Or could it be the case that maybe from your last 10 losing trades, you broke your rules sometimes? You didn't wait for the right entry. Maybe you were on the wrong time frame. Maybe you were aboard. Maybe you did revenge trading. Maybe you over traded. Maybe there was something that you did wrong with your stop loss. Maybe there was something you did wrong with your exit. You exited too early, too late. Could this be the case? And what I'm seeing in 95% of the cases is that it is not the problem of the strategy. It's not the case that the trader is applying the rules 100% and the trade is falling. It's usually the case that the trader is making a mistake. The trader is not trading within the strategy and then the trade is failing. And if this is the case, you cannot blame the strategy. You cannot move to a new strategy and then expect different results. If you have a strategy right now and if you cannot follow the rules, then moving to a new strategy is not gonna fix your problems. Your problems are you. The problems is your discipline, and you need to work on that first. You can't change to 100 different strategies and you will always have the same outcome. As long as you haven't fixed the root problem being you will not see an improvement in your strategy. That's very important. Maybe one of the most important things that I see in my coaching as well. Tips for new and struggling traders. So first of all, I would really recommend that if you have a strategy, you write down your rules, you write down a checklist for your entries so that you can make sure that you have a more consistent approach and you can catch yourself whenever you are breaking your rules. And then second, make sure that you are recording all of your trades. Make sure that you have a trading journal. Every trading book that you read, whether it's the Market Wizards or whatever trading book, come into my trading room, every trading book recommends a trading journal as the #1 most important tool for any trader. And that is the main reason why we also created Edgewonk. Edgewonk is a very popular trading journal created by us, and we understood very early on in our own trading, but also when working with other traders, that having a good trading journal is the key to success. So make sure that you have a journal. Preferably you have Edgewonk. Make sure to check the link in the video description to get Edgewonk as well. And that is what I would recommend to new traders. The connection between win rate and reward to risk ratio. This is, I think, something that many traders don't understand. Many traders want to have a high win rate and they want to have big winning trades. But you can only have one or the other. Why is that? Because obviously if you want to have a high reward to risk ratio, which means that you have really big winning trades, this comes at the expense of your win rate. Because if you are swinging for the fences, very often you will not, your trades will not make it. They will turn around before your target. So high win rate and high reward to risk ratio cannot be combined. You have to settle for one or the other. And in my coaching, what I have seen is very helpful to new traders is that you go for a high win rate and a lower reward to risk ratio. So you have a high win rate, but when you have a winning trade, they're not as big. You're not having a home run every single time. Why is that helpful, and why can this be helpful? It's because in the beginning, one of your biggest problems are gonna be probably a lack of confidence and a lack of trust in your trading strategy. And to overcome that, the high win rate is the most important component, because with a high win rate, you're going to have constant positive feedback. You're going to have winning trade after winning trade. Okay, occasionally there is going to be a loss, but a high win rate is going to help you push through the hard times. A high win rate is going to make your trading much easier, more fun, because you have frequent winning trades. And it's not as important to have really big winning trades in the beginning. You can work on that later. But to make sure that you're not becoming a victim of system hopping, of losing your mental capital and just going down the wrong path, a high win rate is usually the way to go. So really make sure that you understand the connection. Go for a high win rate, but don't hit or swing for the fences. Lower reward to risk ratio, that's really the way to go. I've mentored hundreds and hundreds of traders, and I've seen that this connection is usually where you want to go. So that's it for this video. I hope you enjoyed it. 10 swing trading strategies, a lot of practical tips that you can use, hopefully. So make sure to leave a comment, leave a thumbs up, make sure to subscribe to the channel, and then I will see you in a few days with the next video.